Adrian, awesome to see you, man.
Hey, Dominick, how you doing? Thanks for having me back.
Yeah, absolutely. Really excited to dig into the show today. We are going to be covering the big, beautiful bill. And right now we are recording this show on August 1st. So I'm sure there's going to be additional clarifications and revisions. But we wanted to go through it and go through some of the high level things and where it's going to impact a lot of small business owners, a lot of individuals. So hang tight with us. We're about to get really nerdy and into the weeds, and this is going to be a fun show for sure. So I've been looking forward to it a while. So Adrian, where should we start?
I was gonna say we could maybe take it from the top. Some of the bigger provisions. I know that the tax rates from TCJA from 2017 have been made permanent. So I believe the minimum bracket I think is 10% now for federal income tax, and then the maximum bracket is at 37%. I think there was going to be some expiration where that was going to go back to the 39.6%, but it sounds like that's not the package.
Yeah, excellent. Okay, so tax rates are not changing. That's good. And they've also made changes to the standard deduction, right?
They did. They increased it actually starting 2025. So I will say we're all going to kind of see the benefit of our taxes from that.
Yeah,
so,
excellent.
I would, because a lot of people were worried about that dropping kind of down, and a lot of people are going to itemize and stuff. But with the increased standard deduction, honestly, I think itemizing is still going to be kind of more rare than it used to be before.
Sure.
For example, for married couples, $31,500 standard deduction. I mean, that's it's not chump change. Not this kind of. So those were made permanent.
Yeah, awesome. And they also made. There was some talk about wanting to change the way Social Security income was taxed for retirees, but it sounds like that didn't quite end up making it into the bill. But they did make some adjustments for seniors in terms of the deduction that they're eligible to receive, right?
That's correct. Yeah. So normally right now seniors get, I think it's like $1,500 or something for being over the age of 65, I believe. Now I think they increased that to like 6,000 or 8,000. I think per spouse.
Okay.
So seniors, I mean, you guys are going to see some, depending on what your taxable income is, that's a pretty big increase for your standard deduction. So
excellent. That's great to hear. Great to see. Now let's shift gears a little bit, because we do, I work with a lot of small business clients, and so let's kick it off with QBI. Can you kind of tell us and define what QBI is, the way it works, and just high level some of the changes that are being implemented with this new bill?
Yeah. So not to get too technical, basically the QBI deduction is if you have a trade or business that isn't subject to a taxable income limit phase out, you get basically a 20% deduction on your qualified business income. And it applies to a lot of trades and businesses. Usually the fields like health, accounting, law, those are known as specified service trades and businesses. They have more of a specific carve out. But most trades and businesses qualify for QBI. So there was talk about raising that deduction to 23%. That didn't make it up into the final bill. It still remains at 20%, but it has been made permanent. So it was set to expire. That's what everybody, all your CPAs and enrolled agents everywhere were like, we learned this for the last 8 years. Is it going to expire? Are they going to make it permanent? It is now permanent. So now for planning purposes, QBI is around to stay. You can, factor that into your return on investment calculations for getting into different businesses, eligibility requirements, that kind of thing. So QBI is still 20%, but it's permanent now.
Okay, excellent. That's more good news for small business owners.
Absolutely.
Now let's go a little bit deeper into this provision that you and I were like talking about, digging into it. Really excited to get into it. So qualified small business stock. There's been some changes to that, which, is going to benefit business owners who qualify and who are transitioning out of their business. So can you take us through, the various components of that?
Yeah. So basically qualified small business stock, long story short is you basically incorporate a C corporation here in the United States to participate in some sort of traded business. I think it has to be in a certain field. I think it's like health, law, accounting, those kinds of fields. You have to be also under a certain asset limit to stay as a qualified small business. And basically, the longer you hold the stock in this qualified small business, and then you eventually go to dispose of it, exchange it, or sell it, the shareholder of that qualified small business stock gets to exclude a certain amount of that gain. My understanding right now is at 3 years of holding the stock, you get to exclude half the gain under the BBB. You hold the stock for 4 years, you can exclude 75% of your gain. And then you hold it for 5 years or more and you go to sell it, you get to exclude 100% of the gain. Like I said, there's an asset limit. I believe the company has to stay under $75 million to qualify to remain a qualified small business. And then there is a gain. I think it's like a cap, like a gain exclusion cap. I think it's 15 million. I think for the shareholder.
Okay.
So as long as you stay kind of in those bounds, which I'm sure honestly a lot of small medium businesses can, kind of depending on what you're doing. I really think this actually might be an incentive to kind of look back towards the C corporation as a business entity, kind of going into the future. Since the LLC and the proliferation of S corps, especially, they've kind of fallen off. They used to be very, very popular. Now with this provision, though, they might make a comeback. Be able to have this business and have it appreciate and grow, and then be able to sell it and basically exclude, assuming you keep the stock long enough to exclude all your gain from that. That's crazy.
That's wild. That is some like serious potential tax savings, right?
Yes, yes, absolutely.
That could be an absolute game changer. I've seen business owners when they're selling their business, it's like there's millions of dollars that are just going to taxes, and if you could plan appropriately and be able to avoid that, like that's huge.
That's huge.
Yeah,
and we can't forget the long-term capital gains rate is 20%. You've got net investment income tax over a certain threshold of 3.8% on the dollar. So if we're talking, you're going to sell, I don't know, say you're going to have a gain of $4 million. Like you might be excluding, like $1 million of tax, almost 25%. So
big deal. Okay, no, that's super helpful, and certainly something for people to like really business owners who are close to retirement should really start to plan and think about, engage with their tax professional on, and like really look at, hey, what does this provision potentially mean for me, and is there anything that we can be proactive and do now? So going a little bit deeper, let's talk about bonus depreciation. There's some changes there. What happened?
Yeah, so bonus depreciation is basically you get to deduct in the year you place something into service, whether it's like vehicles, machinery, equipment. A lot of times it applies to real estate. Qualified improvement properties, one of the categories, improvements to buildings, rentals, parking lots, things like that. I dealt with this a lot in my time at the IRS. A lot of people trying to write off basically 100% of stuff in a year that might not qualify. So always consult a trusted tax professional.
Yes.
So this was phasing out under the TCJA rules. I believe this year, I think it was going to almost phase out completely, or I think it's at like 60%. It was going to go back to like 50% or 40%. So now they brought it back to 100%, and that's been made permanent. So that's a big deal, just because you get to just as you place assets into service this year going forward, you get to just deduct that whole amount of the asset, assuming it's a qualifying asset, entirely. And a lot of the times why people use this is for like short-term rentals. If they're real estate professionals, they do cost segregation studies on commercial buildings. Maybe they have like car washes, little things like that. There's sort of these carve-outs for real estate, and you get to deduct all that, and they're able to kind of harvest these losses and use them to offset other types of income. So this is honestly, bonus depreciation is probably one of the bigger changes in this bill.
Yeah,
it's a big deal.
Yeah. Okay. So that's definitely something for people to start to factor in now. You can start planning out, how you're going to reinvest, like in your properties or in your business, and be able to make sure that you're minimizing your potential tax exposure through that. So definitely something to engage in, think about. Okay. So pivoting more from, some of the major changes that happen on the business side. Let's focus on how this income will flow through and start to impact on the personal side. There's some changes to what's called the SALT cap. So take our audience through, like, what is SALT reference in the first place?
Yeah, so SALT stands for state and local taxes.
Okay.
So on your federal income tax return, assuming you itemize your deductions, there's a standard deduction, itemized deductions. Assuming you itemize, you can only deduct, or at least you used to be able to only deduct up to $10,000 in state and local income tax. And so, for a lot of the people in some states don't even have income tax, right?
Right.
And then in other places, like it's super high, New Jersey, New York, California, us in
Yeah.
California.
Yeah.
So you were basically limited on, hey, the amount of state and local taxes as an individual that I can deduct off my taxes. So now that limit's been raised from $10,000, which was, I don't know, fairly low, I think, for example, for a high tax state like California. So now it's gone up to 40,000, and they adjusted for inflation now. And so that's pretty crazy, because where someone was limited to that 10,000, but they have property taxes, they have sales taxes, maybe they're especially a high income earner. I mean, now that they get to potentially deduct another 30,000 in state local income taxes and real estate taxes and vehicle license fees, like for your DMV registration, that's a big deal, especially if you're in one of the more higher marginal tax brackets, 22%, 24%, kind of getting up there. You might be saving a quarter on the dollar for the next 30,000, for your state local taxes. So that's a big deal. That's also a big change. I think a lot of people are going to see their tax bills go down because of that provision.
Yeah.
Assuming they itemize.
Yep. No, that's definitely great news for the individuals that fall into that category. There's also some changes to 1099 reporting requirements, right?
Yes. So back, and this wasn't even that long ago. I think it was a couple of years ago. They wanted to change the 1099K, which is like the third-party merchant processor requirements. People who like do Zelle, Square,
PayPal,
Stripe, all that, especially for business purposes. They had reduced that threshold to $600. Basically, Stripe and Square and the rest of them were supposed to send you a 1099K for if you had $600 or more in a transaction amount for the year. Now they've reverted back to the old rules, which is either 200 transactions per payee or 20,000 in aggregate volume. And so, if you were worried about having like personal eBay sales and how they're getting reported to the IRS and stuff like that, now it's less likely, unless you're actually probably in a serious trade of business, that you're going to get it 1099K and you don't need to freak out. I can attest to this personally. A lot of people were freaking out, like, oh my God, like what if I get a 1099K? Yeah. The IRS actually flip-flopped on this rule a couple times. They wanted to do it, and then they got like a stay for another year, and then they were going to implement it again, and then it stopped again. It's been a whole thing. So they've gone back to the old rules.
Okay.
Another change has been, you might have heard of a 1099 NEC, non-employee compensation. Yep. So before, you had to issue a 1099 for anybody that you gave $600 or more to. They've raised that cap to $2,000 now. So depending, side job or you got a subcontractor or something like that, there's a higher threshold now before you have to give them a 1099. So
got it. So let's talk about something else that is changing, and it seems like a lot of these changes are actually going away. Let's talk about energy and tax credits for energy efficient initiatives. So take us through that.
Yeah. So I think actually it's a large number of the clean energy tax incentives. For example, one of them is like a clean energy vehicle. You buy a Tesla, you buy the ignition cars and all that. You used to get, I think it was $7,500 as a tax credit on your federal tax return. So my understanding is after September 30th of 2025, like they've gutted all that basically. Like you get real no clean energy benefit for buying a clean energy vehicle now. There's one specifically for commercial vehicles. There's one just for a clean vehicle credit. They got rid of that. There's like an alternative fuel refueling credit, I think, for like natural gas vehicles, E85, that kind of thing. I think they've gotten rid of that. And then there's also the energy efficient home improvement credit. I've actually seen this a lot, both in my audits and also preparing tax returns. People getting solar on their house, smart meters, you name it, right? They've gotten rid of like a lot of that, so you might not see any benefit from putting solar and other types of alternative energy on your home anymore. And that was a big one. I think you used to get up to like 30% of the improvement cost on your principal residence, and solar isn't cheap,
right?
40 grand for a good system.
Yeah.
So that's, it's unfortunate, really. There's going to be a lot less of an incentive to do a lot of these clean energy stuff now, at least from a federal tax perspective.
Sure. Yeah, certainly. You mentioned Teslas and vehicles. There's also a change on the way auto loan interest is treated, right?
That's correct. So there's, and my understanding is I don't think you have to itemize deductions to get this. I think it's like a straight just adjustment to your income, assuming you qualify. Is it an itemized deduction? I don't believe so. So basically, you get to exclude, I think, for any passenger automobile vehicle that's purchased from 2025 through 2028, you get to deduct from your taxes a certain amount of the car loan interest that you're paying on that. Let's see. So it's got to be for a vehicle acquired this year. I know, and it sucks because I bought a Toyota Sienna last year, and so I was like, if you guys have made that retroactive, man, that would have been cool. You have to buy it this year going forward.
Okay.
So I was like,
Okay.
That sucks.
Yeah.
But you get to exclude. I think there's an overall limitation. Yeah, 10,000 per year. 10,000 per year, and then it does phase out depending on your modified adjusted gross income. 100,000 for singles, for individuals filing single, and then 200,000 for taxpayers married filing joint. So, if you're looking for a new family car or something like that, or maybe you were going to buy another vehicle this year anyway. Yep. I think the vehicle does have to be manufactured in the United States. It can't be overseas. Okay. It's got to originate from here, be manufactured here. Now you're going to see a benefit on your taxes for that.
Yeah. That is so interesting to me because we've never been able to do anything like this before with vehicles, right?
That's right. That's right. That's correct.
Yeah. Another change, speaking of vans for families, is there's been some changes to the child tax credit, right?
Yep. So it used to be, I believe it was $2,000 per child, and that was going to phase out, I believe, after this year. It was going to go back down to just $1,000 per child. So now I think it's been made permanent to $2,200 per child, and then a portion of that is, some of that's refundable, some of that's non-refundable, and now it indexes to inflation as well. So I believe that the 2,200 will just keep going up. There is, let's see, there's an increased phase-out limit. It's 200,000 for single taxpayer, and then 400,000 for a joint return. So that's cool. I mean, more money in Americans' pockets, especially when they have children.
Yeah,
every little bit helps in this economy.
Yeah. No, I mean, I know when this bill was being debated, there's larger numbers being thrown out there. So happy to see that it went up and didn't, end up phasing back down. So yeah, really interesting that, that component is, indexed for inflation. So really, really happy, on that side. Another really big change that applies to both business owners and to individuals is the way overtime and tips are taxed.
Yep.
Right. So take us through that.
So for the tips, for the no tax on tips, there's a temporary deduction of up to $25,000 for qualified tips received by a person who normally and ordinarily customarily receives tips in their profession. Okay. So for example, waiter, server, something like that.
Yep.
Right. So there's going to be new requirements about employers. They're going to have to report specific amounts on their W-2. Mm-hmm. But honestly, it'll probably be pretty easy for a tax software to just kind of walk you through and exclude that tips portion. You still, to my understanding, you still pay FICA and Medicare on it. It's just the income tax portion of it gets excluded. Yep. And this will be a big change, especially if you are somebody who works in a service profession. I mean, I can tell you, I've talked to a lot of bartenders, a lot of waiters, a lot of servers. They love their job because they're like, dude, tips, I make, $30, $40 an hour with tips. Yeah. And it's so this is going to be a huge change, especially for being able to exclude up to $25,000 from your gross income because of tips. That's a huge deal.
Yeah.
Something similar for overtime. I think you have to be a Fair Labor Standards Act subject to employee. So there might be some stuff if you have a collective bargaining agreement that aren't subject to FLSA rules, So I would kind of look into more of this when they have come up with some more regulations and rules. If you're a police officer, a firefighter, a lot of salaried employees, we don't get overtime, unfortunately. But there's an exclusion there for that overtime portion of pay. It's going to be up to $25,000 in the case of a joint return, or $12,500 if you're a single filing taxpayer.
Yeah, so. Excellent. That's great. Now, another subject that we were talking about before the show started, and there's a lot of buzz about it, are these new Trump accounts.
Yep. So my understanding is they're basically like an IRA, but for the benefit of a child. Basically, anybody under 18 years old. There's even a tax credit, I guess. If you open up one of these for a child born in 2025 onward, and you put a certain amount of money, I'm not even sure they specify what amount of money, you get $1,000 tax credit on your federal income tax return, which is great. It's great. Yeah. So it's incentivized saving for children and saving for your kids. Employers can contribute up to $2,500 into a Trump account for a beneficiary under 18. And then there's an overall $5,000 limit per year for contributions. So,
okay.
If you got, I guess if you want to have, more kids kind of going now into the future, I mean, it's something to consider for starting to stock some money away, on the
Right.
ventures.
Yeah. Now, and so how are these accounts treated tax wise? Is it like a Roth IRA? Is it like a traditional IRA? Can you dig into that a little bit more?
Yeah, my understanding is they're more like a Roth IRA, so you're not going to get any sort of tax benefit, I guess, besides a tax credit for contributing to it today.
Right. Sure.
And then there's certain exclusions you get from when you're going to withdraw the money. I believe you can't touch the money until the beneficiary is 18. There's certain early withdrawal exceptions. I think there is an early withdrawal penalty for that as well. So it's more like a Roth IRA than any sort of traditional vehicle. It's very, very unique. I don't know. There's a lot of other vehicles kind of like this. So
yeah.
I would use this in conjunction with. There's a new benefit with 529 plans.
Mm-hmm.
So 529 plans. Now, I believe if you don't use all the 529 funds for the beneficiary for who the 529 was meant for, you can actually roll that now into a Roth IRA or another Roth vehicle. I imagine, honestly, if you set up a 529 and a Trump account for your child, especially going into the future, those can work a lot in conjunction with each other. Just these vehicles that can kind of grow tax-free for the benefit of your kid and, save as much money in your pocket as you can. I think there's a lot of planning opportunity with accounts.
Yeah. And so in order to be eligible for this credit for making a contribution, the child has to be born this year. So if your child was born 2024 previously, you're out of luck, right?
Yeah, I think they're out of luck. Yeah, it's got to be someone from now going forward. And I thought I even saw something, I guess the federal government, assuming you open it with a qualified financial institution, they'll even throw some money in there for you on behalf of the qualifying child. I think it's $1,000.
Wow.
So get out there and have some kids, people.
Yeah.
So,
yeah. No, amazing. Yeah. No, like from a financial planning standpoint, I think there's just tons of opportunity to dig into this, understand it. It's like, and make sure that you're fully optimizing it. And, Adrian, to your point, using, 529 plan and, Roth IRAs as, part of a bigger strategy will be important depending on what you're looking to accomplish. So, I mean, all this is just amazing stuff. From, planning perspective, Adrian, I know you're very unique in the industry and you like to engage with your clients. You like to have these planning conversations, throughout the year, not just when you're sitting down across the desk from someone on April 15th. Right. That's right. In terms of, these highlights here, anything else that you would encourage our audience to think about or engage with their tax professional on?
I mean, I would say if you're a business owner, I think the increased bonus depreciation percentage, that's a huge one, especially if you're a real estate professional, you have rentals, that kind of thing. If you're doing cost segregation studies regularly, I'm sure, Dominick, you've got, we've all got real estate clients. There's a lot of land in California, a lot of real estate. That's a huge change, I think, from a tax perspective. There's a lot of planning and opportunity there. Honestly, I think your average American really will be benefiting from this. The standard deduction increase, the increased child tax credit. There's a charitable contribution deduction. You might have seen it before from COVID. It was like you got like $300 or like $600 as a charitable deduction, and you didn't have to itemize. Now you just get it. They have a new provision that for single filers it's $1,000, and then for married filing joint it's $2,000. So you can now just donate to your charity and be able to get a deduction on your taxes, and it helps you out. And for some people, $2,000 deduction isn't chump change. That's a big deal. Like, I think your average person really is going to see some reduced tax bills because of this. There's a lot of opportunity here for wise tax planning. Dominick and I, we always encourage you to talk to a qualified tax professional, your CPA, your EA. Just stay abreast on tax law changes, whether you're a family or a small business owner. There's a lot. There's a lot here.
Lot here. Yeah, no, I've been engaging with my, clients on this and, trying to identify specifically the areas that apply to them and make sure that they're thinking about it and, integrated into planning. And, it always, is so annoying to me when, I see these missed opportunities and, it's not until April 15th that people are discovering, oh man, I should have done this or that. And it would have saved me, $10,000 or $20,000 if I'd made these, adjustments per year. So, yeah, make sure that you're engaging with your financial professional, with your CPA, and really making sure that you're maximizing the financial opportunity here.
Absolutely.
Yeah. Excellent.
Absolutely.
Well, Adrian, it's been amazing having you on. Really enjoyed our discussion today. Any parting words for our audience?
I think no. I mean, I think we covered a lot today. We covered a lot of topics.
Yeah. Excellent. Well, thanks so much for your time and your contribution. And yeah, if anyone wants to reach out to us, we're looking to help more people. So we're always happy to have a conversation and see how we can help. So thanks all.
Thank you, everybody. Thank you, Dominick, for having me. Take care, everyone. Thank you.